Before we start, it's crucial to state that the information in this video is for educational purposes only. It is not financial, legal, or insurance advice. I am not a licensed insurance agent, and you should always consult with a qualified, licensed professional to discuss your individual circumstances. Think of this as your pre-game strategy session before you talk to the pro coach. I still remember the smell of my first car. It was a 10-year-old Honda Civic, slightly faded blue, with a mysterious stain on the passenger seat and a cassette player that only worked on Tuesdays. But it was mine. It was freedom on four wheels. I spent weeks saving, negotiating, and finally I held the keys in my hand. The feeling was electric. And then came the gut punch. The car insurance quote. It was almost as much as my monthly car payment. I stared at the number on the screen and my heart sank. I thought, this has to be a mistake. How can it cost this much just to be allowed to drive the car I just bought? The truth is, it wasn't a mistake, but I was about to make one. Huge one. The same $1,000 mistake that an estimated 40% of first-time drivers in America make every single year. They overpay. Massively. Not because they're bad drivers, but because nobody ever taught them how to play the game. That's why we're here today. This isn't just a video. This is your step-by-step playbook to navigate the confusing, frustrating, and ridiculously expensive world of your first car insurance policy. My goal is simple: to take you from total confusion to complete confidence, and in the process save you hundreds, maybe even thousands of dollars. We're going to pull back the curtain on how insurance companies really decide what you pay. It feels like a black box, right? You type in your name, your car, your address, and a mysterious algorithm spits out a number that can make or break your budget. They look at things you expect, like your driving record, but they also look at things you would never guess. Your zip code can change your rate by 50%. Your credit score, in most states, can have a bigger impact on your premium than a speeding ticket. They look at the exact model of your car, not just that it's a Ford Fusion, but which specific trim package it is, because one has a slightly higher theft rate in Des Moines, Iowa. It's an incredibly complex system designed to do one thing: accurately predict risk. But for you, the first-timer, it feels designed to do one thing: cause a migraine. We're going to dismantle that system piece by piece. Over this series, we're going to cover everything: how to understand what liability, collision, and comprehensive actually mean in plain English, how to find every single discount you're entitled to, from good student discounts to ones you've never even heard of. We'll talk about how to compare quotes from different companies like a pro, without getting tricked by flashy ads or confusing jargon. And most importantly, we will walk you through, click by click, the process of getting that very first quote so you know exactly what to expect and what to do. But before you can run, you have to walk. And before you can even walk, you have to tie your shoes. Today, we're focusing on the single most important step in this entire process. It's the prep work, the foundation. It's what separates the people who save $1,000 from the people who waste it. Most people just jump onto a website and start plugging in information off the top of their head. That is a recipe for disaster. Why? Because inaccurate information leads to an inaccurate quote. You might get a quote that's way too high and you get scared off. Or worse, you might get a quote that's way too low, you buy the policy, and then a month later they do a records check, find the real information, and your premium suddenly doubles. No surprises. No mistakes. We're going to do this right from the very beginning. Think of this first step like a scavenger hunt. Your mission is to gather a few key documents and pieces of information. Having all of this ready in one place before you even visit a single insurance website will make the process 10 times faster, 100 times less stressful, and will guarantee your quotes are accurate. First up, the star of the show, your car. You need its vehicle identification number, or VIN. The VIN is like your car's social security number. It's a unique 17-digit code that tells an insurance company everything it needs to know: the year, make, model, engine size, the plant where it was built, and even its specific safety features. This number is critical. Don't just guess. It's a 2018 Toyota Camry. Is it the LE, the XSE, the V6 model? Does it have anti-lock brakes, automatic emergency braking, a lane departure warning system? You probably don't know all that off the top of your head, but the VIN does. And those safety features can unlock serious discounts. So where do you find it? It's in a few places. The easiest is on the driver's side of the dashboard, right where the dashboard meets the windshield. You can see it by looking through the glass from the outside. It's also printed on a sticker on the driver's side door jamb, and it will be on your vehicle's title and registration documents. Write this number down. Double check it. Every single digit matters. Next, you need the car's current mileage. The odometer reading. Be precise. Don't guess around 50,000. If it's 52,417, write that down. Why? Because mileage is a direct indicator of wear and tear and usage. It helps them assess the car's value and how much it's being driven. While you're at it, think about how you'll be using the car. Will this be your daily commuter to work or school? So, what's the one-way mileage? How many days a week will you be driving? They will ask you for an estimated annual mileage. A good way to calculate this is to take your daily round-trip commute, multiply it by the number of days you work a week, then multiply that by 50, allowing for 2 weeks of vacation. Then add a few thousand miles for weekend trips, errands, and other driving. Be realistic. Lying and saying you only drive 2,000 miles a year when you're really driving 15,000 is insurance fraud, and it can get your policy canceled and claims denied when you need it most. Okay, that's the car. Now let's talk about the driver, or drivers. You'll need the full legal name, date of birth, and driver's license number for every single person in your household who might drive the car, even if it's just occasionally. Your spouse, your roommate, your teenager who just got their permit, you need their info. Hiding drivers is another big no-no. So, get their license out and copy the number down exactly. You'll also need the address where the car will be garaged, which is just insurance speak for parked most of the time. This is usually your home address. This is one of the biggest factors in your rate. Parking a car in a quiet, rural town is seen as less risky than parking it on the street in a dense city with higher rates of theft and accidents. Be honest about this address. Finally, gather your personal history. Do you have a copy of your driving record? If you've had any tickets or accidents in the past 3 to 5 years, you'll need the dates and details. If you don't remember, you can often request a copy of your motor vehicle report from your state's DMV website, sometimes for a small fee. It's better to know for sure than to guess. Also, think about your education. If you're a student, you'll need proof of your grades. A recent report card or transcript showing a B average or higher can unlock a significant good student discount, sometimes up to 25%. That's real money. Don't leave it on the table. So let's recap your scavenger hunt list. 1. The 17-digit VIN. 2. The exact odometer reading and your estimated annual mileage. 3. The full name, birth date, and driver's license number for every driver in the house. 4. The primary address where the car will be parked. And 5. Your driving and academic history. Get all of this together. Open a document on your computer or grab a real-life notepad and write it all down. Put it in one place. This is your quoting toolkit. With this information prepared, you are already ahead of 90% of first-time insurance shoppers. You're prepared, you're organized, and you're ready to get quotes that are real, accurate, and comparable. You've built the foundation. Now it's time to build the house. So, how do you build that house? Do you hire a famous architect who only builds one style of stunning, reliable home? Do you find a custom home builder who works with a variety of materials and blueprints? Or do you head to the hardware store, buy a kit, and build it yourself? This is the first major decision you have to make, and it's the one most people don't even realize is a choice. You have to decide how you're going to get your quotes. There are 3 main paths, and the one you choose will fundamentally shape your entire insurance experience, not just today, but for years to come. Let's call the first path the specialist. This is your captive agent. A captive agent works for one and only one insurance company. Think of the big names you see on TV every day: your local State Farm agent, your Allstate agent, your Farmer's agent. They are experts, specialists in a single brand. Going to a captive agent is like walking into an Apple store. The person who helps you, the genius, knows every single detail about every iPhone, every MacBook, every software update. They can tell you exactly how all the products work together in a beautiful, seamless ecosystem. They can bundle your phone, your watch, your laptop, and your tablet into one perfect package. It's a guided, curated experience. But what they will never ever do is tell you that maybe a Samsung Galaxy or a Google Pixel is a better fit for your needs or your budget. Their entire world, their entire expertise is confined to the 4 walls of that one brand. The upside here is immense, especially for a first-timer. A good captive agent is a teacher. They'll sit down with you, explain the coverages, and hold your hand through the entire process. You build a personal relationship. When you have a question, you call Jane, not a 1-800 number. When you have a claim, Jane is your first call, your advocate within the company. They are masters of their company's discounts. They know how to bundle your car insurance with a future renter's or homeowner's policy, to save you the most money within their system. The value is in the service, the relationship, and the deep product knowledge. The downside is the flip side of that same coin. A complete lack of outside options. They can't shop around for you. If their company's rates go up next year, their only solution is to reevaluate your discounts within that same company. They can't check to see if a competitor could save you $300. Their loyalty is by design to the company that signs their paychecks. So with the specialist, you're betting that their combination of service and their company's pricing is the best overall value for you. Now for the second path, the personal shopper. This is your independent agent or broker. Unlike the captive agent who represents one company, an independent agent represents you. They are contracted with multiple different insurance companies, sometimes a dozen or more. Think of it this way. Instead of going to the Apple Store, you've hired a personal tech shopper. You tell them, I need a new phone. I value camera quality, battery life, and I have a budget of $800. That personal shopper doesn't care if the best phone is an Apple, a Samsung, or a Google product. Their job is to go to all the different stores, compare the models that fit your specific needs, and come back to you with the top 2 or 3 options, explaining the pros and cons of each. Their loyalty is to you, the client, because they want you to be so happy with the result that you come back to them for all your future tech needs. This is the power of an independent agent. You fill out one application, have one conversation, and they do the heavy lifting of shopping you around to multiple carriers to find the best combination of coverage and price. They can often find a home for drivers who might be harder to insure. And just like the captive agent, you get a personal advisor, someone to call with questions, but their toolbox is much, much bigger. If your rate with company A goes up at renewal, your independent agent can simply reshop you with company B, C, and D, often without you having to do anything. So what's the catch? Well, while they work with many companies, they don't work with all of them. Some of the biggest direct-to-consumer companies don't use independent agents. Also, the quality of independent agents can vary. A great one is an invaluable asset. A lazy one is just a middleman. They might also not have the same microscopic, encyclopedic knowledge of every single internal policy of a specific company that a 20-year captive agent would. Their knowledge is broader, not necessarily deeper. With the personal shopper, you're betting that choice and having an advocate who works for you will lead to the best outcome. Finally, we have path number 3. The DIYer. This is going direct to consumer. This is you on a Tuesday night in your pajamas going straight to the websites of companies like Geico, Progressive, or Lemonade. You are the agent. You are the architect and the builder. This is like going on Amazon to buy your phone. You have access to a staggering amount of information. You can read reviews, compare specs side by side, and filter by price, brand, and features. You are in 100% control. You can add the phone to your cart, remove it, add a different one, and check out in 5 minutes at 2 in the morning. There's no salesperson, no pressure. You can tweak a dozen different variables and see the price change in real time. It's fast, it's convenient, and it often feels like you're getting a great deal because you're cutting out the middleman. The power of the DIY path is that speed and control. You can get 5 different quotes from 5 different companies in under an hour. For someone who understands insurance and knows exactly what they want, this can be the most efficient path. But the danger is massive, especially for a first-time buyer. When you go direct, you are the expert. There is no one there to ask you, are you sure you want the state minimum liability? Do you understand that if you cause a serious accident, that will only cover the first $25,000 of medical bills, and you'll be on the hook for the rest? There's no one to explain why collision coverage is different from comprehensive coverage. The website will let you choose the cheapest options, even if those options leave you dangerously exposed to financial ruin. You save 15% or more, but you might be saving it by unknowingly giving up the very coverage you'll need after a major accident. And when you have a claim, you're not calling a personal agent. You're calling a 1-800 number and becoming just another claim number in a massive system. With the DIYer, you're betting that your own knowledge is sufficient to protect yourself, and that the convenience outweighs the lack of personal service. So we have the specialist, the personal shopper, and the DIYer, and you don't have to choose just one. A smart strategy is to use the DIY path to get a baseline. Go to a direct writer's website, get a quick quote to see a ballpark number. Then call an independent agent and say, here's the quote I got. Can you beat it? This gives you the best of both worlds. A quick word on those online comparison sites, the aggregators. These sites are not insurance companies or agents. They are lead generation machines. You put your information in one time, And they sell that information to a dozen different agents and companies who will then all start calling and emailing you. It can be a useful tool if you want to cast a very wide net, but be prepared for your phone to start ringing. It's less of a path and more of a bullhorn shouting your information into the marketplace. Choosing your path is the strategic decision that sets the stage for everything else. Do you want a dedicated expert from a single trusted brand? Do you want a personal shopper who can browse multiple brands on your behalf? Or are you confident enough to build it all yourself? There is no wrong answer. The right answer depends entirely on your personality, your comfort level, and how much guidance you want. But now the moment of truth arrives. You've chosen your path. You've picked your guide or decided to go it alone. You're sitting across the desk or staring at the screen, ready to finally get that number. And they ask you the single most important question in this entire process. What kind of coverage do you want? And suddenly you're hit with a tidal wave of jargon, a wall of words you've heard but never understood. Liability, collision, comprehensive, bodily injury, uninsured motorist, MedPay, PIP. What do these words actually mean? What do they do? And most importantly, which ones do you actually need to protect yourself and which ones are just expensive add-ons? Choosing the right ones is the difference between a minor inconvenience and total financial devastation. And that is exactly what we are breaking down next. Let's start with the absolute bedrock of any car insurance policy: liability coverage. This isn't a suggestion. In 49 out of 50 states, it's the law. Why? Because this coverage isn't for you. It's for everyone else on the road. Liability pays for the damage you cause to other people and their property if you're at fault in an accident. It's broken into two critical parts: bodily injury liability and property damage liability. Imagine you're driving on a rainy Tuesday morning. You glance down at your phone for just a second and bam! You rear end the car in front of you. The other driver is complaining of neck pain, and their bumper is now sitting in the middle of the road. This is where liability springs into action. Bodily injury liability covers the other person's medical bills, their lost wages if they can't work, and even their pain and suffering. Property damage liability covers the cost to repair or replace their car that you just crumpled. When you look at a quote, you'll see these coverages listed as three numbers like 25/50/25. This can look like some kind of secret code, but it's actually simple. The first number is the maximum amount, in thousands of dollars, the insurance company will pay for one person's injuries in an accident. So 25 means $25,000. The second number is the maximum they'll pay for all injuries in a single accident. So 50 means $50,000 total even if you injure 3 people. The third number is the max they'll pay for property damage. So 25 means $25,000 for the other car or cars. Now here's the terrifying part. Those 25/50/25 numbers are often the state-mandated minimums. Let's go back to that rainy Tuesday. What if the car you hit wasn't a 10-year-old sedan but a brand new Audi? That $25,000 in property damage coverage might not even be enough to replace the bumper and the fancy sensors inside it. And what if the driver you hit is a surgeon who can't perform surgery for 6 months because of the neck injury you caused? Their medical bills and lost income could easily soar into the hundreds of thousands of dollars. Your $25,000 or $50,000 of bodily injury coverage would be exhausted in a heartbeat. And guess who's personally on the hook for the rest? You are. They can sue you. They can go after your savings, your assets, and even garnish your future wages for years. This is why simply getting the state minimum is one of the biggest financial risks a person can take. Liability coverage is about protecting your entire financial future from one bad moment on the road. Okay, so liability covers the other guy. But what about your car? In our scenario, your front end is a mess. Your headlights are shattered. Your hood is buckled. Liability does absolutely nothing for you. To fix your own car after an accident you caused, you need collision coverage. This is the part of the policy that pays to repair or replace your vehicle if you hit another car, a pole, a guardrail, or even flip your car over. It's your safety net for your own mistake. Collision coverage comes with a critical component: the deductible. A deductible is the amount of money you have to pay out of your own pocket before the insurance company pays a dime. Let's say your car has $5,000 in damage, and you have a $500 deductible. You pay the first $500, and the insurance company pays the remaining $4,500. If you choose a higher deductible, say $1,000, your monthly premium will be lower. But it means you need to be able to come up with that $1,000 cash if you get into an accident. Choosing a lower deductible, like $250, means your monthly premium will be higher, but your out-of-pocket costs will be less after a crash. This is a personal choice based on your budget and your emergency savings. If your car is an old beater worth $1,500, paying for collision coverage might not make sense. But if you have a newer car or a car loan, it's not just a good idea. Your lender will almost certainly require you to have it. Now, what if the damage to your car had nothing to do with driving? What if you wake up one morning and a huge tree limb has fallen and crushed your roof during a storm? Or your car gets stolen from your apartment's parking lot? Or a deer decides to play chicken with you on a country road at dusk and loses? Collision coverage won't help you here, because you didn't collide with another vehicle or object as a result of driving. For these acts of God and general chaos, you need comprehensive coverage. Comprehensive covers theft, vandalism, fire, hail, flooding, and hitting an animal. It's the life happens coverage. Just like collision, it also has a deductible. So if that deer does $3,000 of damage and you have a $500 comprehensive deductible, you pay $500, and insurance covers the other $2,500. Many people get confused between collision and comprehensive. Just remember, collision is for when your car hits something. Comprehensive is for when something happens to your car. Together, they are often referred to as full coverage. Now for a coverage that is one of the most tragically overlooked, yet critically important: uninsured or underinsured motorist protection. Let's flip our accident scenario. This time, you're the one sitting at the red light, minding your own business. Suddenly, you get rear-ended by someone texting and driving. They hit you so hard your car is totaled and you have to be taken to the hospital. It's clearly their fault. But then you get the bad news. The driver who hit you has no insurance at all. Or, almost as bad, they have that bare-bones state minimum policy we talked about earlier. Your medical bills are already at $80,000 and climbing, but their policy only covers $25,000. What happens now? You can sue them, sure. But if they don't have insurance, chances are they don't have any money or assets to give you. You can't get blood from a stone. You're left with a mountain of medical debt and no car. All because of someone else's irresponsibility. This is where uninsured and underinsured motorist coverage becomes your financial superhero. It steps in and acts like the other driver's insurance. Your own policy will cover your medical bills, your lost wages, and your pain and suffering, up to the limits you selected. It protects you from the financial recklessness of others. In some states, it can also cover the damage to your car, but its primary job is to protect your body and your bank account. Speaking of protecting your body, let's talk about two more coverages: medical payments, or MedPay, and personal injury protection, or PIP. These are designed to pay for your and your passengers' medical expenses right away after an accident, regardless of who was at fault. If you have a $5,000 MedPay limit, you can use it immediately to pay for your ambulance ride, emergency room visit, or physical therapy, without waiting for the insurance companies to fight over who's to blame. Personal injury protection, or PIP, is similar but more robust. In states called no-fault states, you're required to have it. PIP not only covers medical bills, but it can also cover things MedPay doesn't, like lost wages if you can't work, and even services you now have to pay for because of your injury, like childcare or house cleaning. It's designed to get you back on your feet financially as quickly as possible. Finally, we get to the so-called expensive add-ons. These are the coverages that aren't about financial devastation, but about major inconvenience. The two most common are rental reimbursement and roadside assistance. Rental reimbursement does exactly what it sounds like. If your car is in the shop for a covered repair after an accident, it pays for you to have a rental car. It's usually sold with a daily limit, like $30 a day, for up to 30 days. If you only have one car and you rely on it to get to work, this coverage can be an absolute lifesaver, and it usually only costs a few dollars a month. Roadside assistance is your backup for when you get a flat tire, lock your keys in the car, or run out of gas. Instead of having to find and pay for a tow truck yourself, you just call the number on your insurance card. Again, it's a small monthly cost for major peace of mind. So there you have it. Liability, collision, comprehensive, uninsured motorist, MedPay, and the extras. These aren't just random terms on a form. They are the individual bricks you use to build your financial fortress. Liability protects your future from others. Collision and comprehensive protect your vehicle. An uninsured motorist and MedPay protect you and your family. The key isn't to just get insurance. It's to build the right wall of protection for your specific life. Now that you know what the bricks are, how high should you build the walls? How do you decide between a $500 deductible and a $1,000 one? Or $50,000 in liability versus $250,000? This is the single most important question in this entire process. And the answer isn't found in a rulebook. It's found by looking at your own life, your assets, and your future. Let's start with the big one, the one that can change your life forever. Liability coverage. Think of liability limits as the height of the financial fortress you're building around yourself. State minimums? That's like building a picket fence. It might check a box and keep the dog in, but it's not stopping a real threat. Let me paint a picture for you. Let's say your state minimum for property damage is $25,000. That sounds like a lot of money, right? Until you're driving on the highway, you glance down to change the song, and you rear-end a brand new Ford F-150. That truck is easily a $60,000 vehicle. Your insurance pays the first $25,000. Who pays the other $35,000? You do. The other driver's insurance company will pay to fix their client's truck, and then their lawyers will come after you personally for that $35 grand. And that's just the truck. What about the people inside? Let's say your state minimum for bodily injury is $50,000 per accident. The driver and passenger in that truck both get whiplash and a few other injuries. They go to the hospital, need physical therapy for a few months, and miss work. Their combined medical bills and lost wages quickly soar past $100,000. Your policy pays the first $50,000. Who pays the rest? Again, you do. In one split second, a simple mistake has you on the hook for over $100,000 that your legal insurance policy didn't cover. They can go after your savings account, your investments. They can put a lien on your house. And if you're young and don't have many assets, they can garnish your future wages for years, even decades. Every paycheck you get, a piece of it goes to paying for that one bad moment. This isn't a scare tactic. This is financial reality. This is why choosing your liability limits is not about finding the cheapest option. It's about deciding how much your financial future is worth. So, how much should you get? A classic rule of thumb is to have liability coverage equal to your net worth. Your net worth is everything you own, your savings, home equity, investments, minus everything you owe. If you have a net worth of $200,000, you should have at least that much in liability coverage. But for most people starting out, your biggest asset isn't what you have now. It's your potential to earn in the future. A lawsuit doesn't care if you have money today. It cares if you will have money tomorrow. So here's a more practical guideline. I would never recommend anyone drive with less than 100/300/100. Let's break that down. $100,000 in bodily injury coverage for any single person you injure. $300,000 in total bodily injury coverage for the entire accident if multiple people are hurt. And $100,000 in property damage coverage. This is a solid, responsible foundation. It's the difference between a picket fence and a real brick wall. A better, even safer level? $250/500/100. That's $250,000 per person, $500,000 per accident, and $100,000 for property. The surprising thing is, the jump in price from state minimums to $100/300/100 is significant. But the jump from $100/300/100 to $250/500/100 is often shockingly small. You might be talking a few extra dollars a month for an additional $150,000 of protection. It is the single best bargain in the entire insurance world. When you're getting quotes, always price out both options. You'll be amazed at how affordable true peace of mind can be. Now let's talk about deductibles. This is for your collision and comprehensive coverage, the stuff that fixes your car. The deductible is the amount you pay out of pocket before the insurance company pays a dime. This is where you have more control, and the decision is a lot simpler. It boils down to one question. How big is your emergency fund? Your deductible should be an amount of money you could comfortably pay right now in cash without causing a financial crisis. If you choose a $1,000 deductible, you are telling the insurance company, don't worry about the first $1,000 of damage. I've got it. In exchange for you taking on that initial risk, they give you a lower premium. If you choose a $500 deductible, you're saying, I only want to be on the hook for $500. So the insurance company takes on more risk and they charge you a higher premium. So which should you choose? Look at your bank account. Do you have at least $1,000 set aside that is purely for emergencies? If the answer is yes, then a $1,000 deductible is a fantastic way to save money on your premium. If you look at your account and a surprise $1,000 bill would force you to use a credit card or borrow money, then you absolutely should not choose a $1,000 deductible. Stick with $500. Don't gamble with money you don't have. You can even do the math. Let's say raising your deductible from $500 to $1,000 saves you $20 a month, or $240 a year. By choosing the higher deductible, you're taking on an extra $500 of risk. It would take you just over 2 years of being accident-free for the premium savings to cover that extra risk. It's a bet on your own driving. If you're a safe driver and you have the cash on hand, it's often a good bet to make. Next up, uninsured and underinsured motorist coverage. Remember our horror story about getting hit? Let's flip it. What if someone with a terrible state minimum policy hits you? What if they have no insurance at all? Right now, about 1 in every 8 drivers on the road in America is completely uninsured. That's a terrifying statistic. If one of them hits you and puts you in the hospital, you can sue them, but you can't get blood from a stone. If they don't have money or assets, you're stuck with your own medical bills. That's where uninsured motorist coverage saves you. It acts as the other driver's liability policy when they don't have one. So how much should you get? The answer is simple. This is the mirror rule. You should get the exact same amount of uninsured motorist coverage as you have in bodily injury liability coverage. If you chose 100-300 for your liability, you get 100-300 for your uninsured motorist. If you chose 250-500, you mirror it. The logic is powerful and undeniable. Why would you provide a stranger you hit with more financial protection than you provide for yourself and your own family? Protect yourself to the same level you're required to protect others. It's that simple. Finally, there's medical payments or MedPay and personal injury protection or PIP. These are designed to cover initial medical expenses for you and your passengers after an accident, regardless of who is at fault. The amount you need here depends almost entirely on your health insurance. If you have a fantastic health insurance plan with a low deductible, say $500, and low copays, you might not need a lot of MedPay. Maybe just a few $1,000s to cover that deductible and some initial costs. But if you have a high deductible health plan, where you have to pay the first $5,000 or even $10,000 of your medical bills out of pocket, then MedPay becomes critically important. It can bridge that gap. A good starting point is to select a MedPay or PIP limit that is at least equal to your health insurance deductible. It's a relatively inexpensive coverage that can prevent an auto accident from turning into a health insurance nightmare. So let's recap the fortress. Your liability limits are the high, strong walls that protect your entire financial future from a catastrophic lawsuit. Your deductible is the gate, and its size is determined by the cash you have on hand in your emergency fund. Your uninsured motorist coverage is the defense tower you build for yourself, and it should be just as tall and strong as the walls you build to protect others. And your MedPay is the medic in the courtyard, ready to patch things up right away, with its strength determined by the backup you have from your health plan. This is the strategic thinking that separates a cheap, flimsy policy from a smart, protective one. You are no longer just buying insurance. You are designing a custom-fit suit of financial armor. Now that you know exactly what coverages and limits you're aiming for, you're ready for the next step, gathering the arsenal of information you'll need to actually get the quotes. Think of this step not as homework but as assembling your dossier. It's the intelligence-gathering phase of a critical mission. Walking into a negotiation unprepared is the fastest way to lose. Walking in with every single piece of data at your fingertips? That shows you're a serious player. It makes the process faster, the quotes more accurate, and it prevents you from having to stop, search for a document, and lose your momentum. We're going to organize this into 3 distinct files: the U file, the car file, and the history file. First up, the U file. This is all about your personal details. It sounds basic, but each piece tells a part of your story to the insurer's algorithm. You'll need your full legal name, your current home address, and your date of birth. No surprises there. They need to know who you are, where the car will be parked overnight, which is a major rating factor, and how old you are. Next, and this is the big one, your driver's license number. This is the master key that unlocks your official driving record. When you provide this, you're giving the insurance company permission to pull your motor vehicle report, or MVR. This is the official state record of you as a driver. It's non-negotiable, so have that little plastic card handy. Now for the one that makes people nervous, your social security number. Let's be very clear about this. Why on earth do they need something so sensitive? In most states, insurers use your credit history to generate something called an insurance score. This is not the same as your FICO credit score, but it's based on similar information. Statistically, data has shown a strong correlation between how a person manages their financial responsibilities and how likely they are to file a claim. Is it controversial? Yes. Is it a reality of the insurance world in most of the country? Also yes. Providing your social security number is often optional, but not providing it can mean you're automatically placed in a more neutral or even a lower-tier risk group, which can result in a significantly higher quote. My advice? When you're dealing with a major, reputable insurance company, the big names you see on TV, their data security is incredibly robust. Providing it will almost always get you a more accurate and often a much cheaper rate. If you're on a website you've never heard of and it feels sketchy, trust your gut. But for the main players, it's a standard part of the process that can save you real money. The U-file also includes a few more personal data points: your marital status, your occupation, and your level of education. Again, this isn't about judging you. It's about statistics. Decades of data might tell an insurance company that a married accountant with a master's degree who works from home is, on average, a lower claims risk than a single bartender who drives home late at night. They are painting a portrait of your risk profile, and every detail adds a brushstroke. Be honest. Okay, you file assembled. Next, the car file. This is the dossier on your vehicle. The single most important piece of information here is the VIN, the vehicle identification number. This 17-digit code is like your car's DNA. It's not just the year, make, and model. It tells the insurer the exact engine size, the type of transmission, the country it was made in, and most importantly, the specific safety features it was equipped with at the factory. Anti-lock brakes, electronic stability control, side curtain airbags. The VIN tells them everything, and those safety features can earn you discounts. Where do you find this magic number? It's usually on a little metal plate on the driver's side of the dashboard, visible through the windshield. It's also on a sticker on the driver's side door jamb, and it's printed on your vehicle registration and title. Don't try to just wing it with, "It's a red 2018 Honda Civic." Get the VIN. It is the source of truth for your vehicle, and it guarantees you're getting a quote for your exact car, not a generic version of it. You'll also need an estimate of your car's current mileage. Just grab the number from the odometer. It helps them gauge the car's current condition and usage. And speaking of usage, you need to define the vehicle's primary use. Is it for commuting to work or school? If so, how many miles one way? How many days a week? Is it just for pleasure, weekend trips and errands? Or is it for business, like making deliveries or visiting clients? Be honest. A business use vehicle is a higher risk and costs more to insure. And if you have an accident while using it for business but it's insured for pleasure, your claim could be denied. Utterly denied. Finally, for the car file, how do you own it? Is it financed, meaning you have a car loan? Is it leased? Or do you own it outright, title in hand? This is critical because if you have a loan or a lease, your lender, the bank, is a part owner of that car until you pay it off. And they have rules. They will almost certainly require you to carry collision and comprehensive coverage to protect their investment. If you own the car outright, that choice is yours alone. That brings us to the final folder, the history file. This covers your driving and insurance history. You'll need to list all licensed drivers in your household. Anyone who lives with you and has a driver's license, your spouse, your partner, your roommate, your teenage kid, the insurance company needs to know about them. They represent a potential risk because they have regular access to your car. You'll need their full names and driver's license numbers too. Then comes the tough part, your record. You need to be prepared to list any accidents, tickets, or claims you've had in the last 3 to 5 years. And I'm going to tell you something right now, do not lie. Don't omit that speeding ticket from 2 years ago. And don't pretend that fender bender never happened. They are going to find out. As soon as they run your driver's license number and your VIN, they pull 2 massive industry reports. The MVR we talked about and something called a CLUE report, which is a database of all prior auto insurance claims. If you lie and they find a discrepancy, they might not just raise your quote, they could deny your application outright for misrepresentation. It's far better to be upfront and own your history. Lastly, you'll be asked about your prior insurance coverage. As a first-time buyer, you may not have any, and that's okay. Just select No Prior Insurance. But if you were listed on your parents' policy, that counts. Having a history of continuous insurance coverage, even on someone else's policy, makes you look more responsible to an insurer. A lapse in coverage, however, is a big red flag. It tells them you've been driving uninsured, which is a major risk, and they will charge you significantly more for it. So if you have prior coverage, have the company name and your old policy number handy. Can be a huge money saver. And there you have it. Your complete intelligence dossier. Your personal info, your vehicle's DNA, and your unvarnished history. It seems like a lot, but having all of this organized in one place, a notepad, a document on your computer, transforms you from a casual shopper into a prepared professional. You are now ready to engage the market with speed and precision. You have your custom coverage plan. You have your complete intel dossier. Now it's time to enter the arena. But where do you go to get these quotes? Do you call the agent your parents have used for 20 years? Do you go directly to the website of that company with the funny commercials? Do you use one of those online tools that promises to compare dozens of quotes at once? The path you choose here isn't just about convenience. It can change the price you pay by hundreds, even thousands of dollars a year. Each one has hidden strengths and secret weaknesses. In the next part, we'll break down the 3 main battlegrounds for buying car insurance, and I'll show you exactly how to navigate each one like a pro. Alright, let's dive into the arena. There are 3 primary ways you can buy car insurance, and thinking of them as simple options is a mistake. They are fundamentally different strategies, each with its own set of rules, advantages, and hidden traps. Master them and you control the game. Ignore them and you're just a pawn. First up is what I call the direct assault. This is you on your own going straight to the source. You've seen the commercials a million times. The gecko, the quirky lady in the white apron, the emu. You pick a company, let's say Progressive, you go to their website and you begin the ritual. You enter your name, your address, your date of birth, your car's VIN number. You answer questions about your driving history, your job, your marital status. 15, maybe 20 minutes later, you get a number, a quote. Then you do it all over again for Geico, and again for State Farm, and again for Allstate. The appeal here is obvious. Feels simple. It's direct. There's no middleman. You are in complete control, dealing one-on-one with the company that will ultimately hold your policy. For some people, this is a perfect fit. If you have a super simple situation, one car, one driver, a perfect record, and you already have a brand you trust, going direct can be fast and clean. Sometimes, companies that primarily sell direct even offer unique discounts because they aren't paying a commission to an agent. It feels like you're cutting out the fat and getting right to the meat. But the direct assault has a massive, glaring weakness, and it's the one most people fall victim to. It creates a powerful illusion of savings. You spend an entire afternoon filling out 5 different online forms. You get 5 different quotes. Maybe they range from $90 a month to $120 a month. You pick the $90 one and pat yourself on the back. You save $30 a month. You feel like a genius. But what you don't see, what you can't see, are the 20 other insurance companies you didn't check. You have no idea if one of them, a smaller regional carrier perhaps, would have offered you the exact same coverage for $65 a month. You only know you got the best price out of the tiny self-selected sample you had the time and patience to check. You're comparing prices in a single aisle of the grocery store, completely unaware that the store next door has a massive sale on the exact same product. The time and energy it takes to repeat this process over and over is the enemy. Most people give up after 3 or 4 quotes, and insurance companies count on that. They know that once you've spent an hour on their site, you're less likely to go do it all again somewhere else. This brings us to our second strategy: hiring a seasoned guide. This is the independent insurance agent. Now, it's critical to understand the difference. There are captive agents who work for only one company, like State Farm or Allstate. They are part of the direct assault strategy. We're talking about independent agents. These are professionals who don't work for an insurance company. They work for you. Think of them as a personal shopper for insurance. You have one conversation with them. You give them all your information once. Then they go to work, using their specialized software and industry relationships to shop your policy across a dozen or more different insurance carriers. Companies you might not have even heard of, like Erie Insurance or Auto Owners. The primary advantage here is expertise and efficiency. A good agent lives and breathes this stuff. They understand what uninsured motorist bodily injury stacking actually means and whether you need it. They can look at your life, your job, your commute, your assets, and give you actual advice on what coverage levels make sense. They aren't just selling you a product, they're providing a service. They can often find hidden discounts you'd never think to ask for. More importantly, they have access to carriers that you, as a consumer, do not. Some of the most competitive and highly rated insurance companies in the country only sell their policies through independent agents. You cannot go to their website and get a quote. So, by ignoring this channel, you might be leaving the best possible option completely off the table. And down the road, if you have to file a claim, a good agent becomes your advocate, your representative who can help you navigate the often confusing and stressful claims process. But this strategy has its own pitfalls. The quality of your guide matters immensely. A great agent is a trusted advisor for life. A bad agent is just a salesperson trying to hit a monthly quota. They might steer you towards a policy that pays them a higher commission, not the one that's truly best for you. And the biggest limitation is this. Even an independent agent doesn't represent everyone. They only work with the companies they have an established partnership with. You'll notice that the big direct-to-consumer players, the Geicos, the Progressives, are almost never on an independent agent's list. Why? Because those companies built their entire business model on cutting out the agent. So, even your seasoned guide can't see the entire map. They can only show you the paths they know and have access to. This leads us to our third and final battleground, the most modern and most misunderstood of them all, digital reconnaissance. This is the world of the online insurance comparison website. You know their names, the Zebra, NerdWallet, Compare.com. The promise is intoxicating, the ultimate shortcut. Fill out one form, and their powerful technology will instantly scan the market and show you quotes from dozens of companies side by side. It's the direct assault's biggest weakness, the time sink, solved by technology. It's the independent agent's biggest weakness, their limited carrier list, solved by data aggregation. Seems like the perfect, unbeatable strategy. And for getting a quick, high-level snapshot of the market, these sites are incredibly powerful. In 5 minutes, you can get a ballpark idea of who is offering competitive rates for someone with your profile. It's a fantastic starting point for your research. But you must, and I mean must, understand the business model behind most of these sites. You are not the customer. You are the product. Here's the secret they don't want you to know. When you fill out that form and click See My Quotes, you're not always getting real bindable quotes. You're getting estimates, teaser rates, and more importantly, you have just become a lead. That information you just entered, your name, email, phone number, and the fact that you're actively shopping for car insurance is a valuable commodity. These websites often sell your data, your lead, to a network of hungry insurance agents and companies. What happens next? Your phone starts to ring, and ring, and ring. You'll get emails. You'll get text messages. Agents from companies you've never heard of will start calling, all having paid for the privilege of getting your contact information. For some, this is fine, they want the calls. But for most, it's an overwhelming and annoying invasion. Furthermore, the quote you saw on the screen often changes. Once an actual agent takes your lead and runs your official driving record and credit history, that amazing $60 a month price might suddenly jump to $95. The comparison site's job wasn't to get you the final accurate price. It was to get you interested enough to submit your information so they could sell it. So we have 3 distinct battlegrounds. The direct assault, which gives you control but is slow and provides a narrow view. The seasoned guide, who offers expertise and access but can't show you the whole market. And the digital reconnaissance, which is incredibly fast and broad but can be inaccurate and turn you into a product to be sold. Each has a fatal flaw. So what do you do? How do you choose? The answer is you don't. You don't choose one. The secret, the pro-level strategy that insurance insiders use, is to combine all 3 into a single cohesive plan of attack. You use the strengths of each strategy to cancel out the weaknesses of the others. You use technology for speed, a human for advice, and your own diligence for verification. And in the next part, I'm going to give you the exact step-by-step playbook for how to do it. We're going to build your personal quoting machine. Alright, let's fire it up. Every great machine needs 2 things: the right components and a clear set of instructions. This is your instruction manual. We're going to do this in 3 distinct phases. Phase 1, the assembly. This is where we gather every single piece of information you'll need. Phase 2, the activation. This is where we plug you into the system and start generating real numbers. And Phase 3, the readout. This is where we learn how to organize and understand the data that comes flooding back. Get this right and you'll never feel powerless in this process again. Let's start with Phase 1, the assembly. Think of this like prepping your ingredients before you start cooking. Doing this work up front will make the actual quoting process 10 times faster and 100 times less stressful. You'll need to gather a few key documents and pieces of information about yourself and your vehicle. First, your personal details. This is the easy stuff. your full legal name, your date of birth, and your current home address. Now, the address is more important than you think. Insurance companies operate on a principle of risk pools, and your zip code is a massive data point. It tells them about local traffic patterns, weather events, and even crime rates like vehicle theft. Moving one town over can literally change your premium by hundreds of dollars. So make sure the address is accurate. Second, your driver's license number. This is your unique identifier in the driving world. When you provide your license number, you're giving the insurance company permission to pull your motor vehicle report, or MVR. This is your official driving record as kept by your state's DMV. It lists any speeding tickets, accidents, or other violations. A quick word of advice here: be honest. If you got a speeding ticket 2 years ago, don't try to hide it. They are going to find it. Lying on your application is a guaranteed way to have your quote invalidated or your policy canceled down the road. It's just not worth it. Third, and this is the big one, your vehicle information. You need the year, make, and model of the car you want to insure. But the golden ticket is the vehicle identification number, or the VIN. The VIN is a unique 17-digit code for your specific car. It's like a social security number for your vehicle. It tells the insurer everything: the engine size, the manufacturing plant, the safety features it was built with. You can find the VIN on a small metal plate on the driver's side dashboard, right where it meets the windshield. It's also on a sticker on the driver's side door jamb and on your vehicle's title and registration. Now, what if you haven't bought the car yet? Great question. You don't need to own the car to get a quote. Just go to a dealership's website, find the exact car you're planning to buy, and pull the VIN right from the online listing. This allows you to get a precise quote for that specific vehicle before you even sign the papers. This is a pro move. You should always know the insurance cost before you commit to a car, because a cheap car with sky-high insurance isn't a cheap car at all. Fourth, your driving history. We touched on this with the MVR, but you should have a clear idea of your recent past. Specifically, any accidents or claims you've made in the last 3 to 5 years, regardless of who was at fault. Also, list out any traffic violations. Have the dates ready. They will ask. Fifth, your social security number. Okay, let's talk about this because it makes people uncomfortable. Why on earth does a car insurance company need your social? The reason is something called an insurance score, or a credit-based insurance score. Decades of data have shown a strong correlation between how a person manages their credit and how likely they are to file an insurance claim. It's not the same as your FICO score, but it's derived from similar information in your credit report. A better credit history often leads to a significantly lower premium. I know it feels invasive, but in most states, providing it will almost certainly get you a better rate. Reputable insurance companies have robust security measures to protect this data. If you're really against it, you can get a quote without it, but just know you're likely leaving money on the table. And finally, think about your current or prior insurance. If you have it, have your policy number and the company name handy. If not, no problem, but if you do, they'll want to know to check for continuous coverage, which can earn you a discount. Okay, phase 1 is complete. You have assembled all the components. You have your personal info, license number, the car's VIN, your driving history, and your SSN ready to go. Now for phase 2, the activation. It's time to turn the machine on. We're going to follow the 3-pronged strategy we discussed. Technology for speed, a human for advice. We'll start with technology. Open your web browser. Your first stop is 2 different online insurance comparison websites. These are the big aggregators that shop your information around to multiple companies at once. You enter your data one time and they spit back a list of initial quotes. Your goal here isn't to find the perfect policy. It's to cast a wide net and establish a baseline. What is the general price range for someone like you in your area with your car? Fill out their forms completely and accurately using the information you just gathered. This should take you maybe 15 to 20 minutes total for both sites. Once you have those baseline numbers, your next step is to go direct. Pick 2 or 3 of the major household name insurance companies, the ones you see advertised everywhere. Go directly to their websites and fill out their quote applications. Why? Because sometimes the biggest players don't participate in the aggregator sites, or they offer different rates or web direct discounts if you come straight to them. You're cross-referencing the market. Again, use your prepared information. This process will now be incredibly fast because you're not hunting for documents. You're just doing data entry. Now you should have a handful of quotes. You have the results from the aggregators, and you have the results from the direct carriers. You have a solid, data-driven picture of the market. Now, and only now, do you execute the final step of phase 2. You pick up the phone. You are going to call one local independent insurance agent. You find them by searching for independent insurance agent near me. Look for one with great reviews. When you call, you're no longer a rookie asking, "What should I do?" You are now an informed consumer. You can say, "Hi, I'm looking for my first car insurance policy. I've already received a few quotes online. My lowest quote for a 6-month policy with these specific coverage levels is X dollars. I was hoping you could use your network of carriers to see if you can find a better value for me." Do you see the power shift? You are now in control. You've given them a target to beat and shown them you've done your homework. The agent now works for you, trying to leverage their expertise and access to other companies to win your business. This brings us to phase 3, the readout. All this data is useless if you can't understand it. As the quotes come in from the websites from the agent, you need to organize them. Open a simple spreadsheet or even just a notes app on your phone. Create columns for company name, 6-month premium, monthly payment, and then a series of columns for each major coverage type. This last part is the most critical piece of the entire process. You must compare apples to apples. A quote for $50 a month is not better than a quote for $90 a month. If the $50 quote has dangerously low coverage that will leave you financially ruined after an accident, you have to look at the numbers side by side. What is the bodily injury liability? Is it $25.50 or $100-300? What is the property damage limit? What is the deductible for collision and comprehensive? If a company gives you a quote that seems way cheaper than everyone else's, your first instinct shouldn't be excitement. It should be suspicion. Go back and check the coverage levels. They almost certainly lowered something to get that eye-popping price. Your spreadsheet will make this obvious. It will be your single source of truth. So there it is, your quoting machine. Phase 1. Assemble your information. Phase 2. Activate the search using aggregators, direct carriers, and an independent agent. Phase 3. Analyze the readout in an organized apples-to-apples comparison. You have now gone from a complete beginner to a sophisticated insurance shopper in less than an afternoon. But this brings up the most important question of all. Looking at your spreadsheet, you see all these terms: bodily injury, uninsured motorist, collision, comprehensive, MedPay. And you see all these numbers: 50/100/50, a $500 deductible, a $1,000 deductible. How do you decide what you actually need? What do those numbers even mean in the real world? Choosing wrong can be the most expensive mistake you ever make. And that's exactly what we're going to break down next. We're going to translate that insurance jargon into plain English, so you can choose your coverage with absolute confidence. Okay, let's build your financial suit of armor piece by piece. Forget the confusing policy documents for a second. Think of this in terms of 3 core shields that protect you in different ways. The first and most important shield is called liability coverage. This is the one that's not optional. Every single state, except for maybe 1 or 2 with weird rules, legally requires you to have it. But here's the critical thing to understand. Liability coverage isn't for you. It's for them. It's for the other driver, the other car, the other person's property. Protects you by paying for the damage you cause. Let's imagine it. You're driving on a rainy Tuesday. You're a little distracted, you look down for a split second and bam, you rear-end a brand new Mercedes. The driver is okay, but they have a bit of whiplash. Their bumper is toast. This is where your first shield, liability, comes in. It's actually 2 shields in one. First, there's property damage liability. This pays to repair or replace that Mercedes you just hit. It also covers any other property you might damage, like if you swerved and took out someone's mailbox or a storefront window. Second, there's bodily injury liability. This is the big one. This pays for the other person's medical bills, their lost wages because they can't work, and even their pain and suffering. If that whiplash turns into months of physical therapy, this is what covers it. If they decide to sue you, and they can, this is the coverage that pays for your legal defense in any settlement. When you see numbers on a quote like 50/100/25, that's your liability limit. It means your policy will pay up to $50,000 for bodily injury per person, up to $100,000 total for bodily injury for the whole accident, and up to $25,000 for property damage. Choosing only the state minimum here is like going into a sword fight with a shield made of cardboard. A modern car can easily cost more than $25,000 to repair, and a single hospital stay can obliterate a $50,000 limit. If the damages you cause exceed your limits, Guess who pays the rest? You do. They can come after your savings, your investments, even your future wages. This is why liability is the foundation. It protects your entire financial future from one bad moment. So in our rainy Tuesday scenario, your liability coverage pays to fix the Mercedes and covers the other driver's medical bills. The lawsuit is handled. Your financial life is saved. You breathe a sigh of relief. But then you look at your own car. The hood is crumpled, the radiator is leaking, and it's definitely not drivable. You call your insurance company and say, "Okay, what about my car?" And this is where they ask if you have the second shield, collision coverage. Collision is exactly what it sounds like. It pays to repair or replace your car when you are in an accident with another object. That could be another car, a telephone pole, a guardrail, or even flipping your car over. It doesn't matter whose fault it is, because the accident, collision fixes your car. If someone else hits you and they have terrible insurance, collision can fix your car. If a deer runs out in front of you and you hit it, collision fixes your car. Without this coverage, you are completely on your own to pay for your repairs. If you have a car loan or a lease, the lender will almost certainly require you to have it. Why? Because until you pay it off, the car is their asset, and they want to make sure it's protected. If your car is older and paid off, you might decide to skip it. But ask yourself this. If you totaled your car tomorrow, could you afford to buy another one with cash? If the answer is no, you need collision coverage. Now, with both liability and collision, your armor is getting pretty strong. The other driver is taken care of, and your car is in the shop getting fixed. You're feeling protected. Then a week later, while your car is parked on the street, a massive hailstorm hits. Your car is now covered in dents. Or a thief smashes your window and steals your stereo. Or even worse, you wake up and your car is just gone. Stolen. You call your insurance agent, furious, and explain what happened. And they'll ask if you have the third critical shield, comprehensive coverage. This is the one that gets a little confusing. People think comprehensive means it covers everything. Doesn't. A better name for it would be not collision coverage. Comprehensive covers damage to your car from almost everything except a collision. We're talking about theft, vandalism, fire, hail, flooding, falling objects like tree branches, and yes, hitting an animal. Wait, you might be thinking, didn't you just say hitting a deer was covered by collision? This is one of the weirdest quirks in insurance. Hitting a live animal is an act of God and falls under comprehensive. Swerving to miss the deer and hitting a tree instead? That's your fault for swerving, and that's a collision claim. It makes no sense, but that's how it works. The easiest way to remember the difference is this. Collision is for when your car hits something. Comprehensive is for when something happens to your car. So now you have the three main shields: liability to protect others from you, collision to protect your car from accidents, and comprehensive to protect your car from the universe. But there's a catch to using your collision and comprehensive shields. It's called the deductible. The deductible is the amount of money you have to pay out of your own pocket for a repair before the insurance company pays a single dollar. It's your share of the bill. Let's say you have a $500 deductible for collision. In our rainy day accident, the repairs to your car cost $4,000. You pay the first $500 directly to the body shop. Your insurance company then pays the remaining $3,500. If the damage was only $450, you'd pay the whole thing yourself. You wouldn't even file a claim because the cost is less than your deductible. You get to choose your deductible amount, typically from $250 up to $2,000. And this is a huge lever you can pull to control your price. A higher deductible means you're taking on more personal risk, so the insurance company gives you a lower premium. A lower deductible means less risk for you, so they charge you a higher premium. It's a trade-off between saving money now versus saving money later if you have an accident. Okay, your armor is almost complete. But there are a few crucial extra pieces that plug the remaining holes. What happens if someone hits you and it's clearly their fault, but they break the law and have no insurance? Or they have the absolute bare minimum state coverage that doesn't even come close to fixing your car or paying for your injuries. Now you're the victim, but you're stuck. This is where uninsured and underinsured motorist coverage comes in. This is you buying insurance to protect yourself from irresponsible drivers. If an uninsured driver hits you, this coverage steps in and acts like the insurance they should have had. It pays for your medical bills and your car repairs. It is, in my opinion, one of the most important coverages you can buy, because studies show as many as 1 in 8 drivers on the road has no insurance at all. Then there's medical payments coverage, or MedPay. In some states, it's called Personal Injury Protection, or PIP. This covers medical expenses for you and your passengers, no matter who is at fault in an accident. You might think, I have health insurance, why do I need this? Well, MedPay can cover things your health insurance might not, like dental work or ambulance fees. Most importantly, it can cover your health insurance deductible and copays. It's relatively inexpensive and provides an immediate source of cash for medical bills without waiting for fault to be determined. Finally, you have the smaller quality of life coverages. Things like rental reimbursement, which pays for a rental car while yours is in the shop after a covered claim, and roadside assistance, which covers towing flat tires or jumping a dead battery. For a few extra dollars a month, these can save you from a massive headache and a huge unexpected expense. So there it is, your complete suit of armor. Liability, collision, comprehensive, uninsured motorist, MedPay, and the add-ons. You now know what each piece is and what it protects you from. You speak the language. But this leads to the biggest question of all. Now that you know what all the options are, how much do you actually get? How high should you set your liability limits? What's the right deductible for you? Is 100/300/100 enough? Or do you need $1 million umbrella policy? Choosing these numbers is the single most important decision you'll make. And getting it wrong can be just as bad as having no insurance at all. So let's break down those cryptic numbers, because this is where your financial future is either protected or put on the chopping block. When you see a set of numbers like 100/300/100, you're looking at the core of your policy, your liability coverage. This isn't for you. This is for the people and the property you might hit. It's the "I'm sorry I crashed into you" fund. The first number, 100, stands for $100,000. That's the maximum amount your insurance will pay for any single person's medical bills if you cause an accident. The second number, 300, is for $300,000. That's the total maximum your insurance will pay for everyone's medical bills in that single accident, combined. So if you hit a car with 3 people in it, and they all have serious injuries, your policy will pay out a grand total of $300,000, but no more than $100,000 for any one of them. The final number, the second 100, is for $100,000 in property damage. This covers the other person's car, or maybe the fence you smashed through, or the storefront you accidentally redecorated. Now, every state has a legal minimum. In some states, it's shockingly low, something like 25/50/25. Let me be perfectly clear. Buying state minimum insurance is one of the most dangerous financial gambles you can possibly take. It's like going into a sword fight with a butter knife because the law only required you to bring a blade. Think about it. $25,000 for a single person's injuries. A single night in the hospital with a few tests can burn through that. An ambulance ride and an emergency room visit can eat up half of it. What happens when the bills hit $50,000 or $100,000? The other driver's attorney doesn't just shrug and say, "Oh well." They come after you. They look at your savings account, your paycheck, your future earnings. They can garnish your wages for years, even decades. You could be paying for a 10-second mistake for the next 20 years. And property damage? $25,000 might cover a used Honda Civic. But what if you tap the bumper of a new Tesla Model S? The advanced sensors and battery components in that bumper can cost $15,000 to repair. What if you're in a multi-car pileup? What if you hit a brand new F-150 Platinum? That's a $70,000 truck. Your $25,000 policy is a drop in the bucket. The rest comes from your pocket. This is why most financial advisors recommend a minimum of 100/300/100. For many people, especially if you own a home or have significant savings, even that isn't enough. That's when you start looking at 250/500/250, or even an umbrella policy, which is an extra layer of liability coverage, usually $1 million or more, that sits on top of your auto and home insurance. It's surprisingly affordable for the peace of mind it provides. Your goal with liability is to build a wall so high that a lawsuit can't get over it to reach your personal assets. Okay, that covers damaging other people. Now let's talk about fixing your own car. This is where collision and comprehensive coverage come in, and importantly, your deductible. A deductible is the amount of money you have to pay out of pocket before the insurance company pays a dime. It's your share of the repair bill. If you have a $1,000 deductible, and you cause an accident with $7,000 of damage to your car, you pay the first $1,000, and the insurance company pays the remaining $6,000. You get to choose your deductible, usually from options like $250, $500, $1,000, or even $2,000. Here's the trade-off, and it's a simple one. A higher deductible means a lower monthly premium. A lower deductible means a higher monthly premium. By choosing a high deductible, you are essentially telling the insurance company, I'm willing to take on more of the initial risk myself, so you can charge me less every month. You're betting that you won't get into an accident. If you have a healthy emergency fund and can easily cover a $1,000 surprise bill, a higher deductible is a great way to save money. But if a $500 expense would be a crisis for you, you need to choose a lower deductible and pay a bit more each month for that security. Don't pick a deductible you can't afford to pay tomorrow. Now, that deductible applies to your collision and comprehensive coverage. What's the difference? It's simple. Collision covers damage to your car from, well, a collision. Hitting another car, a tree, a guardrail, a pothole that swallows your tire. If you are at fault, this is the coverage that fixes your car. Comprehensive covers almost everything else. Think of it as acts of God or acts of bad luck coverage. A tree branch falls on your car during a storm. Hail turns your hood into a golf ball. You hit a deer on a back road. Your car gets stolen. A rock flies up on the highway and cracks your windshield. None of these are a collision with another object due to your driving, and that's why they fall under comprehensive. Here's a pro tip. For an older car that's paid off and not worth much, maybe $2,000 or $3,000, it can make financial sense to drop collision and comprehensive coverage entirely. Why? Because if the car is totaled, the insurance company is only going to give you what it's worth. If your car is worth $3,000 and you have a $1,000 deductible, the most you'll ever get is $2,000. You have to ask yourself if paying hundreds of dollars a year for that potential $2,000 payout is worth it. For many people with an older beater car, the answer is no. They just keep the liability coverage and bank the savings. So we've covered hurting others and we've covered hurting your own car. But what about the single most terrifying scenario? What if someone with that cheap state minimum insurance, or no insurance at all, crashes into you and puts you in the hospital? This is where uninsured and underinsured motorist coverage becomes your absolute best friend. It is, without a doubt, one of the most important coverages you can buy. 1 in 8 drivers in the United States is uninsured. That's a terrifying statistic. Uninsured motorist, or UM, coverage pays for your medical bills and lost wages if you're hit by a driver with no insurance. Underinsured motorist, or UIM, coverage kicks in when the at-fault driver has insurance, but their low liability limits aren't enough to cover your bills. Let's say your medical bills are $150,000. The guy who hit you has a state minimum policy that only covers $25,000. His insurance pays the $25,000, and then your underinsured motorist coverage steps in to cover the remaining $125,000, up to your policy limit. Without it, you would be on the hook for that money yourself, or forced to sue a person who likely has no assets to begin with. You can't get blood from a stone. You are not insuring them. You are insuring yourself from them. You should always carry UM/UIM limits that are at least as high as your own liability limits. Finally, let's talk about the immediate aftermath. After an accident, liability can take weeks or months to sort out. While the insurance companies are arguing about who is at fault, you still have medical bills that need to be paid now. That's the job of medical payments coverage, or MedPay, and personal injury protection, or PIP. These are considered no-fault coverages. It doesn't matter who caused the accident. This coverage pays for your initial medical expenses and those of your passengers right away. In some states called no-fault states, PIP is mandatory and is your primary source for medical payments after a crash. It can also cover things like lost wages and other related expenses. Even if it's not required in your state, MedPay is often a very inexpensive add-on that provides a critical buffer, ensuring you can get the care you need immediately without waiting for a settlement. Beyond these core coverages, you'll see optional add-ons like rental reimbursement, which pays for a rental car while yours is in the shop, and roadside assistance for tows, jump starts, and flat tires. These are quality-of-life coverages. They aren't about preventing financial ruin, but they can definitely prevent a massive headache. So now you understand the building blocks: liability, collision, comprehensive, UM/UIM, and MedPay/PIP. You know what a deductible is. You are no longer just clicking boxes. You are an architect, designing a custom fortress of financial protection around your life. You are deciding which walls need to be thickest and which gates need to be the strongest. The quote form is no longer an enemy. It's a tool. And now you're ready to use it. So let's pick up that tool. The first place you use it is often the easiest, going directly to the website of a major insurance carrier. You know the names, the ones with the catchy jingles and the celebrity spokespeople. Going direct has its perks. There's no middleman. You're dealing straight with the source, and their websites are usually polished, user-friendly, and designed to get you from start to finish as quickly as possible. You fill out their form using the knowledge you now have, and in minutes you get a number. Your first quote feels like a victory, but this is a rookie mistake. Getting one quote is like visiting one car dealership and buying the first car they show you. You have no context. Is that price good? Is it terrible? You have no idea. The real power, the real savings comes from comparison. And to compare, you need more quotes. At a minimum, you need 3. This is non-negotiable. 3 is the magic number that gives you a baseline, an average, and an outlier. So, how do you get those other 2 quotes without wanting to tear your hair out from re-entering the same information over and over again? This brings us to the second path, the independent insurance agent. Think of an independent agent as a personal shopper for insurance. They don't work for one single company. They represent multiple carriers. You have one conversation. You give them your information one time. They then take that information and shop it around to their network of a dozen, maybe more insurance companies to find you the best combination of coverage and price. This is a massive time saver. More importantly, you get a human expert in your corner. If you have a tricky situation, like a less-than-perfect driving record or a unique vehicle, an agent can navigate that complexity and advocate on your behalf. They can explain the nuances between 2 seemingly identical policies and help you understand why one might be a better fit. The downside? Their service isn't free. Their commission is built into the premium you pay. And while they represent many companies, they don't represent all of them. So you might be missing out on a great deal from a direct-to-consumer company that doesn't work with agents. This leads us to our third and increasingly popular path, the online comparison website. These are the aggregators, the platforms that promise to get you dozens of quotes in minutes. You enter your information once into their master form, and their technology blasts it out to a huge network of insurance partners. The results come flooding in, often presented in a neat, side-by-side table that makes comparison feel incredibly simple. This is by far the fastest way to get a wide snapshot of the market. You can uncover smaller, regional companies you've never heard of that might offer fantastic rates. The catch? You are trading your personal information for that convenience. Get ready for your phone to ring and your email inbox to fill up. You've just told a dozen companies you're in the market for insurance, and their sales teams are going to follow up. Furthermore, the apples-to-apples comparison can sometimes be an illusion. These sites often default to state minimums or basic coverage levels to show you the most attractive, lowest possible price. It's on you to dig into each quote and adjust the coverages to match, so you're truly comparing the same policy. So, which path is best? The honest answer is a combination. A smart shopper does all 3. Get a quote from a big-name direct carrier online. Call one local independent agent and have them shop for you. And use one reputable online comparison tool to see what else is out there. This 3-pronged attack gives you the most comprehensive view of the market. It ensures you're seeing what the big guys, the agent-focused carriers, and the small online players have to offer. Now the quotes are in. You have 3, maybe 5, maybe even 10 different numbers on your screen. This is the moment of truth. But you are not just looking for the lowest number. That's how you lose the game. You are looking for the best value. Here's how to dissect those quotes like a pro. First, look at the premium. Is it listed as a monthly payment or a 6-month total? Pay close attention. Many companies offer a significant discount if you pay for the entire 6-month or 1-year policy upfront. If you can afford to do it, that pay-in-full discount is often one of the easiest ways to save money. Ask yourself, does the lower monthly payment from company A end up costing more over 6 months than the pay-in-full price from company B? Do the math. Second, and this is critical, look at the deductibles. Are they the same on every quote you're comparing? A quote with a $500 deductible will always be more expensive than one with a $1,000 deductible. If you're comparing a quote from Geico with a $500 collision deductible to a quote from Progressive with a $1,000 deductible, you are not comparing the same product. It's apples and oranges. You must standardize your deductibles across all quotes to get a true comparison. Decide what deductible you're comfortable with, and then adjust each quote to match that number before you ever look at the final price. Third, verify the coverage limits. This is the big one. Just like with deductibles, the liability limits must be identical across all quotes for a fair fight. Did one quote default you to the state minimum of 25/50/25, while another quoted you at the 100/300/100 level you actually wanted? That difference in protection is massive, and it will have a huge impact on the price. Go line by line. Bodily injury liability, property damage liability, uninsured motorist. Make sure every number matches the fortress of protection you designed earlier. If they don't match, it's not a valid comparison. Once you have 2 or 3 quotes that are truly apples to apples, same coverages, same limits, same deductibles, only then can you look at the price. But your work isn't done. The cheapest option is not automatically the best option. The final step is to investigate the company itself. A cheap policy from a terrible company is worthless. A company that fights you tooth and nail on a legitimate claim will cost you far more in stress and out-of-pocket expenses than the $100 you saved on your premium. So do a quick reputation check. Go to a site like J.D. Power and look up their auto insurance claim satisfaction ratings. How do they treat customers when things go wrong? Look up their financial strength rating from a service like AM Best. This tells you if the company has the financial stability to actually pay out a large volume of claims in a major catastrophe. You want a company with an A rating or better. Finally, do what you do for any other major purchase. Read reviews. What are actual customers saying online? Are there patterns of terrible customer service or slow claims processing? A company that is $5 a month more expensive but has stellar reviews and a reputation for paying claims quickly and fairly is a much better value. You've done it. You've gathered the information, understood the coverages, shopped the market, compared the quotes on a true apples-to-apples basis, and vetted the companies. You have a winner. Now you simply make the call or click the buy button. They'll ask for your driver's license number and VIN one last time to verify everything. They'll take your payment information, and in an instant you'll be insured. They will email you a declaration page, which is the formal contract, and your new insurance ID cards. You can print them out or, more likely, just save them to your phone's digital wallet. That's it. That feeling of holding proof of insurance for the first time. It's a rite of passage. It's the key that unlocks a new level of freedom. But remember, this isn't a one-and-done deal. Car insurance is not a crock-pot. You can't just set it and forget it. Your life changes, and so do insurance rates. The company that gave you the best rate today as a single renter might not be the best rate in a year after you've gotten married, improved your credit score, and moved to a new zip code. That's why the final secret of the savvy insurance consumer is this. You reshop your insurance every year. Or at the very least, every time your policy comes up for renewal every 6 months. It takes less than an hour, and it can save you hundreds, even thousands of dollars over your lifetime. Mark it on your calendar. Make it a financial ritual. You started this journey perhaps feeling intimidated, confused by a world of jargon and numbers designed to be opaque. But now you see it for what it is. It's a system, and you now have the cheat codes to that system. You know that coverage is about building a fortress, not just checking a box. You know that your personal information is the key to an accurate price. You know that the real power lies not in getting a quote, but in comparing multiple quotes. And you know that the final price is only one part of the value equation. You are no longer just a driver. You are the architect of your own financial security. You are an informed consumer in complete control of the process. So your mission right now is to take this knowledge and turn it into action. Go get your 3 quotes. Go find the best value for you. The road is waiting.